Good morning, everybody. It's Michael here. It's the 4th of April, 2021. The second quarter of 2021 has begun. I hope you are all having a peaceful and restful Easter. Thank God that we're all alive and well. And I also wanted to say thank you to all of you who've been in touch. I do apologize for being away, but some of you may know that I had the unfortunate experience of getting COVID at the beginning of the year, and it's just taken that much time to fully get back into the swing of things. But thank you all for your messages. It was really touching to know that the videos on YouTube have reached so many people and helped so many people. Shout out to Moneyball Austin, FX Telepath. It was cool hopping in on your stream the other day. Lots of good work going on out there in the supply and demand community. A lot of traders are now interested in the methodology, which was the whole aim. It's a really useful market timing tool. So thank you to all of you again. And for those of you on the trading institutional order flow thread on Forex Factory, it continues to grow. Thank you for continuing to share your ideas with each other in a supportive atmosphere. I really appreciate you guys continuing to post and sharing those ideas, and obviously learning from each other. So this is a video I'd been meaning to do before I went off sick, and I thought I might as well do it now as a way of giving back. It really is a way of me giving back to the community, to everyone, just to clear up some of the issues that many of you may have regarding zones and knowing which zones are better than others, which ones to take, which ones to discard. Because there's a lot of information on YouTube about it, on various forums about it, but I'm not so sure a lot of them are really that accurate or based on an understanding of the foundational principles of the methodology, which is something you guys know I'm always talking about, because there are so many practitioners of the methodology now, which is great. But with that has come various interpretations of it, some moving away from the core concepts, introduction of newer concepts, some good, some bad. As always, though, it's important to understand the foundations and going back to the basics, as we say on the channel. So with that in mind, I thought I would prepare a lesson for you today. I hope to do more of these type of things. So bear in mind, guys, this video is going to be longer than I usually do, just because it's my first video back and I've missed you all, and I wanted to give back again, as I said, to the community. So I've put down my thoughts in this very bright red with the white font and stuff, just to get your attention. I hope it comes out clear on the video, and it's going to be quite long, so you will see me scrolling up and down as we move along. So it's a very long lesson. So let's get into it. So we are talking about assessing the quality of a zone, because as you know, there are many zones on a chart, on any given chart, on any time frame. There will be gazillions of zones. Knowing which ones to take, which ones are good, which ones are not so good, why are they good, why are they not so good, can often be a challenge. So that's why I thought we'd do the lesson and really dig into it without any fluff or any, sort of hidden. There are no secrets. There are no secrets in the market. We're all speculators trying to better ourselves. So I think helping each other is always a good thing. So here we go. So the first thing you want to note about a zone is what is often referred to in the supply and demand trading community as the strength of the move away from the zone. Now we know that depending on the market you trade, prices will leave a zone in a particular fashion, some more often than others. Like I've said here, for example, if you're trading stocks, you will always, well, I say always, usually there will be a gap or gaps. That is the, you know, most important representation of a supply and demand imbalance, where there's a gap in price between one price level and another, meaning no trading took place at between those levels because traders were not interested for whatever reason, whether news came out during the night, usually it's news, but for whatever reason traders either really wanted a particular stock or a particular market, that they were willing to buy it at a much higher price than it closed the previous session, or they really wanted to get rid of something so quickly that they were willing to sell it at a much lower price than it closed in the previous session. So in the stock trading world, when you're using supply and demand, it's earnings that often do that. In the Forex market, where it happens less often, for example, it might be a major policy change by a central bank that will result in a gap. But the gap is the largest representation of a supply and demand imbalance. So where you have that, you should always take note of it. I should say that we're talking about assessing qualities of a zone. There are other assessments, and I've made a note at the bottom of this long note about being mindful of that. So I call these ones qualities intrinsic to the zone. So part of the zone, originating from the zone. There are other extrinsic assessments that are outside of the zone but involve looking at the chart itself and looking at other time frames, even looking at upcoming news events, looking at other market correlations that the trader should also make. All right. So the gap away is the largest representation of a supply and demand imbalance. The next best way of prices leaving a zone, or the next best way prices can leave a zone, is via what are called expanded range candles, or large candles, large body candles, the various terms used to describe it, which is where you're looking at big, if you're leaving a demand zone, for example, you're looking at big green candles closing near the highs. If you're leaving a supply zone, you're looking at big red candles closing near the lows. Yes? So we often talk about these being strong closes, where they close near the high if it's a demand zone, or close near the low if it's a departure from a supply zone. So just bear that in mind. I hope that you guys can read the font, because I'm just talking through the points, but I wanted you to have it in writing as well for your reference, and maybe make notes when you watch the video. Okay, so we do have this concept of accumulation and distribution, really important concepts within the market, in looking at the charts as a whole, whether you're doing stage analysis or looking at zones in particular, where we're looking at periods of contracted trading, often referred to as 50% candles, where the open to close range relative to the high to low range of each individual candle is considered independently of each other, and you are looking to see how large is the open to close range relative to the high to low range of that individual candle. If the open to close range is 50% or less of the high to low range, it is often within the methodology referred to as a small candle, a base candle, or a 50% candle. That is what a lot of traders look for, and there are, algorithms. I use some of them on my charts as well for identifying those zones. You can write scripts on TradingView or on your trading platform, whichever one you use, to identify those. Those are good visuals. I much prefer, when it's possible, that you also train your eyes to identify those types of zones, because you may have a platform where you don't have the ability to write a script, or you don't know how to write a script. that kind of thing. So bear that in mind. It's always better to also train your eye so that wherever you are, whatever platform you're using, you can still, draw your zones. All right. So I've described what those zones are: the small candles, the strong closes, the large candles in the note here. Yeah. So that's the second best way that prices can leave a zone: large candles with strong closes. Anything greater than 50% open to close range, greater than 50% of the high to low range is considered by many to be a large candle. Now that can vary. You may decide you want to use an open to close range that is much larger for your expanded range. Your close is 80%. That may be what you decide, right? So that will put a more stringent sort of criteria, which will get you better quality zones, but less frequently. So it's always a trade-off, okay? So that's what we talk about here with the strength of the move away. The third way that prices can leave. So to summarize so far, prices can gap away from a level. That's the biggest representation of a supply and demand imbalance. Number two, prices can leave in a strong fashion with large candles with strong closes. Strong closes near the highs if it's leaving a demand zone. Strong closes near the lows if it's leaving a supply zone. The third way is by leaving a zone in a sort of timid, limping fashion with small candles, or with not so large candles alternating between up candles and down candles, still leaving the zone but in a much less explosive way, if you like. Yeah. So that's the least preferred. Okay. So that's talking about the strength of the move, how prices leave the level. You want powerful departure. It represents sort of the hotness of the zone in terms of the lack of one side of the equation. For demand zones, one side of the equation becomes zero, i.e. the sell orders become zero. You're left with buy orders in the zone, and prices shoot away from that zone or gap away from that zone. Okay. The next intrinsic quality assessment is the amount of time price stays at a level. Now, the foundation of this characteristic, as I've said here, is deeply embedded within one of the assumptions of the methodology, that the less time prices spend at a given price level, say between 50 and 55, for example, or 92 and 92.5, for example, the less time price spends at a level is indicative of the amount of orders to buy or sell left at that level. The less time, the better. Yeah. So the time spent at a level we use within the methodology as a proxy for the amount of supply and or demand that we think may be left at the level. If you are trading a level that prices stayed there within a range up to down, and it stayed there for 10 periods, compare that to where prices stayed within that same range for 6 periods. The assumption within the methodology is that the 6 periods is a better quality zone than the 10 period stay. Yes, the thinking behind it is that the less time you stay, again, the hotter the zone, because one set of orders is quickly absorbed by the other. There are no orders left of the other type, and prices immediately leave the zone, leaving behind the possibility of more buying, for example, taking place if it's a demand zone, or more selling taking place when prices return if it's a supply zone. Okay, I will probably be doing a follow-up lesson to this. This will be the sort of lecture of it, and then we'll do the practical side in another video, just so that this video does not get way too long for you. Okay, so this will be the lesson, and then we'll do another video in a few days with a practical example. So just try and stay with me now. I know it can be a lot, but I'm trying to go as slow as I can so that I carry as many of you along with me as possible. Okay, so as a general rule of thumb, we use 6 periods. Why? Why not 5? There are 5 trading days in a week. A lot of people use daily charts. There are 4 weeks in a month. Why not use 4? Why not use 5 also? Because, well, it's a Fibonacci number, or use 8. That is why I say it is a rule of thumb. The basic concept is you want to be able to see order flow at a level. You can only see that, well, I say you can only, there are other ways of seeing it, but you can see that within the methodology but by looking at the candles within the zone, the trading. They represent the trading within that zone, the back and forth, the buying and the selling. So if you have a decent chunk of them, 6 or less, it's better than having stayed within that zone trading back and forth for 20 sessions or for 15 sessions or for 10 sessions. What you don't also want many of the times is for prices to just stay within the level just for the one period, because that also doesn't really show you enough of an order flow, and you would then need to go down to a lower time frame. But then how far down in time frames do you go, and all of that? So to mitigate for all these concerns within the methodology, it's been devised that as a rule of thumb, you use 6. You want to use enough just for you to be able to see enough of an order flow, but not so much that the quality of the zone in terms of the orders left behind is compromised. So you could use a grading system. Say, for example, you say, I'm going to score a zone that has 3 to 6 candles higher than a zone that has just 1 candle. Or I'm going to score a zone that has 1 to 2 candles, less than a zone that has 2 to 4. If a zone has 4 to 6, it'll get less than a zone that has 3 to 4. So you're looking for that sort of sweet spot. I generally, for my trading, I just use the rule of 6. Most of the time, that's what I do. I don't try to overcomplicate it too much, but we're all different, and that's perfectly fine to want to be a bit more nuanced about that. As I said, what you don't want is for there to be too many periods, and by too many, setting that cutoff point is important. So 6 is the sort of industry standard that is used. Okay, I hope that is clear. It was a long-winded explanation of it, but it's important because it's one of the foundational concepts and one of the differentiating things about the methodology from pure support and resistance trading, for example, which is also a valid way of trading. So how far prices move from the level once they leave the level is the next point. How far prices move on departure from a level before returning to the level. Now that's a measurement that we use to estimate the initial profit potential of a level. So by talking about how far prices moved relative to the level before prices then return to the level to sort of enter a trade, you are measuring that distance relative to the size of the zone, from what is often termed the proximal line to the distal line of the zone, the 2 lines that you draw around your zones, the top one and the bottom one. That distance whether it's 10 pips, 5 pips, 50 pips, that distance from proximal to distal line is what you are measuring to determine how far prices moved away from the level. Okay, so if, for example, the size of your zone from entry line to stop line, or from proximal line to distal line, is 50 pips, and you measure, say you use your Fibonacci tool, for example, to measure from the proximal line, not the distal line, the proximal line, how far prices moved away from that level, and it moved 100 pips. That's a 2-to-1 move away. Now that's the industry standard minimum move away that you want. You may decide that as a minimum for you, in terms of the quality of the zones you want, you decide you want zones where there's been a 2.5 or 3 or 3.5 move away. You'll get less zones to trade, but the zones you do get will be better quality. Now, this is one of the strong points of the supply and demand methodology. Every methodology has strong and weak points. The fact that you can modify these things to suit your personality, to find what you are seeking from the market, is a bonus, so that you are not boxed in by rules within the methodology that are inflexible. It is quite a flexible method. So that's why I'm going to the depths of explaining the nuances of it. You may decide you want zones that the minimum move away is 5-to-1. You're not going to get as many of them than the supply and demand trader who is using the minimum criteria of 2-to-1 move away to qualify his or her zones. But the zones you do get will be of better quality. Okay? Now, so I have something to note here about this particular point. As I said before, it's used as a proxy measure for profit potential. The more the move away, it means the more opposing orders have been removed. Meaning, if, for example, it's a demand zone and prices move away to the upside, they go up with strong candles. For prices to travel that distance, they are removing orders to sell that have been up and to the left of the zone. Okay, and remember I said the next video will go through practical examples, but let's get the theory down first. So if it's a demand zone and prices move up, the only way prices can move up is they're trading through prices, through zones, through levels that are to the left of the zone. So if you start with the zone as your premise and you follow the candles up from the demand zone, for example, follow those candles up, prices are trading higher and higher. They are going through the levels, the price levels on the price ladder up and to the left of the zone. Start from the zone, okay? I hope you can picture that in your mind. All right, so when prices are going up like that, they are taking away orders to the left. It is a crude measure, yes, of profit potential, because there is the possibility that between the time prices have left the level and gone up, for example, if it's a demand zone, that by the time prices are coming back where we have placed our orders at the demand zone, that the supply and demand dynamic has changed. A fundamental event has taken place, a natural disaster has occurred, a policy change has happened, new orders to sell have come into the market because of, a central bank announcement, whatever. Something has happened that has changed the supply and demand dynamic. And as a result, that zone suddenly, that demand zone you were planning to trade suddenly becomes under threat. Because the new dynamic may not be in favor of buying, it may now have changed to be in favor of selling. So wherever possible, as I've said in this note, it is advisable to assess profit potential as prices are returning to the level. If you are trading a more set your orders in and leave them there because you're obviously trading or other things, or you don't pay attention to it, or you have work, or you have family commitments, or you just weren't paying attention for whatever reason, and you set your orders there and that dynamic changes, well, that's one of the sorts of slight downsides to trading the supply and demand methodology that way. I trade the supply and demand methodology that way because I have a lot of other commitments, which is why I mitigate for that by having other stringent measures for assessing the quality of my zones. Wherever I can, if I'm in front of my charts, and I always assess my zones pretty much on a daily basis, to look at the profit potential in particular, because where there's no profit potential, there's no deal. I'm not going to be trading that. So there's no point in me going into a business deal if I'm not, if the chances of me making money off of it are, minimal. I want a deal that I can, make at least, twice what I invest or 3 times what I invest in it. That's a suitable deal. Okay, so wherever I can, I am assessing the zones for profit potential on an ongoing basis as much as I can. Sometimes it's not possible, and the orders are placed and the supply-demand dynamic is still the same as when I set the zone, and the zone plays out. And other times the supply and demand dynamic has changed, the market psychology has changed, the market sentiment has changed, and the zone doesn't work out as well. That's life, that's trading. There's no two ways about it. Okay, so I hope that point is clear, and then I'll move on to the next point. The next point being, did the departure from the zone result in the removal of an opposing zone? If you're looking at a demand zone, did it remove a bunch of sellers to the top and upwards and to the left? If you're looking at a supply zone, did it remove a demand zone to the bottom and to the left of the price ladder? Okay, now this one they're all important assessments, but this one is particularly popular and important within the supply and demand practitioners around the world. The concept of it is that it is a way of assessing, again, how strong that zone is. What was that zone able to manage? Once prices left, how strong was that move? Was it able to ply through a bunch of sellers who were looking to sell to the left and above the demand zone, or to the bottom and to the left if it's a supply zone? Were they able to plow through those opposing orders? If yes, that zone gets an extra brownie point. If it wasn't able to, you're looking at sort of being stuck between that range then, and the profit potential again being decreased. If you imagine you have a demand zone that prices rose up from, and there are sellers above and to the left. I'm speaking to supply and demand traders, so I imagine you guys will have that picture in your mind, or you've seen videos where this is described. But if not, don't worry. As I said, the next video we'll show some chart examples. So if you have a demand zone and prices have left, and you have a supply zone above that prices reach but don't take out, and they start coming down, the question you then have to answer is, who is in control? Because clearly I'm seeing demand zones being created, but the sellers are still dominating price and being able to push it down. So you then have other considerations such as the trend, the location of price on relative to larger time frame levels, etc., to think about. But if you had a demand zone that prices left, and as they left, they fought through the sellers who were above and to the left and managed to take all of them out. And bear in mind, when we say take a zone out within the methodology, we're talking by just 1 pip. It doesn't have to be take out by, a lot. We're talking about just trading through all the orders at that level. and coming out on the other side. So if you're able to take all those sellers out, if you're a demand zone, for example, you get an extra brownie point. Okay? It is important, though, that we understand this is part of a wider assessment. It is not the be-all and end-all of zone quality. Okay? As a standalone measure, it is important, but it is not alone. All right? I hope that is clear. Now, how deep price has penetrated a zone after the zone was created? That is the concept that is referred to as freshness within the methodology. Freshness. Once prices have left a level, they've created the level, prices have left the level, then on their return, well, how many times has price returned is really what we're trying to capture, because it is a measure of how much of the orders are likely to be left. We can never know for sure. There's no way of knowing for sure. But we use it again as a proxy of how many orders are likely to be left at this zone. If prices have left a zone and have not returned at all to the zone, they've just, say it's a demand zone, prices have just risen, and they've not come back to test that zone is said to be totally fresh. Some traders use the term virgin, untouched. Okay? I'll let you decide about those connotations yourself, because we're going to be using terms like penetration, which I'm sure those of you with your minds in the gutter will be thinking, but don't think it. Now, I already put it in your head now, didn't I? Okay. Well, so we are having to think about how far prices have gone into a level. If prices have not returned at all, that's the best scenario. That's totally fresh, right? That will get a higher score than, say, prices have come back to the level once or twice or three times. That is not so good, because with every return to a level, the assumption within the methodology is that more and more of the orders within that level are being used up with each return until that level no longer has any orders and prices will eventually just trade through it. Okay, so you want to be sure you are trading zones that have orders still in them. Okay. Now, I've made the comment in this note that there is one type of a return of price that can actually give us a good inclination of whether there are orders left at a level or not. And that is the initial kiss, the initial touch of the level. So when prices are coming back and they just touch that proximal line, that top line of your demand zone, or that bottom line of your supply zone, near the line nearest to price, prices are coming back to demand, they just touch it or barely reach it or barely miss it, maybe by a pip or two, and then go back the other way. That suggests again the hotness of that zone, that the orders were quite stacked. That's the assumption within the methodology. Every methodology works on assumptions, as I said, so these are the assumptions within the methodology for this particular score. That the reason prices were not able to penetrate any reasonable distance into the level is because there was such a large stack of orders at the level and prices shot away. Okay. Now, the level of penetration can be graded. You could say, I will only trade totally fresh levels, no previous touches, no previous tests. You could decide, I will trade zones that have either not been tested at all, or when they have been tested, prices have not penetrated the zone beyond 25% of the size of the zone. Now remember, the size of the zone is the distance between your entry line, your proximal line, and your stop line, your distal line. Okay? So that distance is what I refer to as the size of the zone. It's what is referred to as the size of the zone. Okay, so the penetration we're talking about is how far prices have traded into that zone, the distance from the entry line to the stop line. Okay, so if you decide, for example, that you are willing to take zones that are either totally fresh or zones that prices may have returned to but have not penetrated beyond 50% of the zone, that is absolutely fine. As long as you downgrade the score of the zone that is not totally fresh. The zone that is totally fresh gets the highest score, always. Any zone that has been tested, whether lightly or deeply, gets a lower score. Okay, so that's the gradation that we're talking about that you need. I don't even know if that's a word, gradation. It probably is, but I don't know. I'm sure you guys will know. But you know what I mean. So that's what we're talking about. Okay. So those are the qualities of a zone that are intrinsic to the zone. To summarize now. Whoops, where did that go? There we go. I should be moving it up or down, not scrolling. Okay. So to summarize again, assessing the quality of a zone using the characteristics of the zone itself. Number one, how did prices leave the zone? Did they gap away? Did they leave by large candles with strong closes? Did they leave limping with small indecisive candles, alternating up and down candles? Yeah? That's the first point. Second point, the amount of time prices stayed at the level before leaving. You want a sweet spot, anything from 3 to 6. 1 to 2 is acceptable, but you also want enough so you can see order flow. Okay? Anything more than 6, 7, 8, you're getting into lesser quality zones. Okay? How far did prices move away from the zone before coming back to it? A proxy measure of initial profit margin. If prices moved away 3 times the size of the zone, it's better than if prices moved away 2 times the size of the zone. If prices moved away only 1 time the size of the zone, meaning an equal distance away to the size of the zone, that's not so good. That's a 1-to-1. Okay? If prices moved away 5 times the size of the zone, measured from the proximal line, that's better than if prices moved away 3 times the size of the zone, measured from the proximal line. Okay? You can use any scores you want, whether you're using 10, 20, 30, or 1, 2, 3, 4, A, B, C, D. If you have your own structure that you understand, it doesn't really matter to anyone else. As long as you who are using it understand it, doesn't matter. You can use 20 for gaps away and 15 for large closes. Doesn't really matter what number, as long as you differentiate what is good, what is acceptable, and what is not so good. Okay? Point 4. Did the departure from the zone remove an opposing set of orders, an opposing zone? Did a demand zone remove a supply zone? Did a supply zone remove a demand zone? Assessment of strength and potential profit margin. A very important assessment, like all others are, but it is not the only assessment that the trader should make. Okay? How deep did prices penetrate the zone once the zone was created? Have prices returned at all? Totally fresh? Have prices returned just one time and barely penetrated the zone? Minimal penetration? Or have prices traded right all the way down to the distal line, right within the zone before reacting? If it's a demand zone, if prices have traded right down to the distal line and then gone up, it'll be hard to justify using that zone again, because the assumption is with the deeper the penetration, the less the orders that are left at the level. Okay. So I think that will do it, guys. As I said, I do apologize for the length of the video, but I wanted to do this as a way of giving back, for having been away for so long, and B, was something I wanted to do anyway. Thank you to all of you who've been in touch with me. I am super behind in my emails, as I said, for obvious reasons, but I am going to be catching up with them. If you wanted to hit me up about the video course, it was a really good uptake with the offer in I believe it was January now, or maybe it was December, I can't remember now, where we gave it out for the reduced costs. So if you're interested in that video course, which goes into much more detail about the methodology, it's storehouseanalytics@gmail.com. In fact, maybe I should write that down for you guys, just so you have it on your Storehouse. I hope I can spell it. storehouseanalytics@gmail.com. So if you wanted to get in touch with me, if you were interested in one-to-one mentoring, or you wanted to get the video course, or you just wanted some clarification on anything, trading, supply and demand, or trading in general, that's the email address to reach me on, storehouseanalytics@gmail.com. Okay. And I will look forward to the next video. It'll be a practical video where we will go through these points. Remember, these are not the only points of assessing the quality of a zone or of a trade, but it is a really good starting point. So I hope it's helpful, and I wish you well in your trading. I'll see you again soon. Stay well, stay blessed.